My name's Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. So, Spencer, thank you so much for joining the What the Finance podcast to talk with me today about your upcoming book, The Revolution That Wasn't: How GameStop and Reddit Made Wall Street Even Richer, which is released on the 27th of January and can be pre-ordered at the moment on Amazon, and I'm sure other places as well. But just on to my first question, sort of what really influenced you to write the book?
Well, I've long been fascinated with finance. I write for the Wall Street Journal, and it's my second career, actually. I worked on Wall Street or in the city, more specifically, at my first career, and decided to go write about it. And I've really always been interested in this sort of the many errors that people make, manias, panics, crashes, what have you. And that's really why I went into financial journalism in large part because I wanted to sort of to point those things out, having seen them myself from the inside of a financial institution. And specifically, what got me interested in GameStop is that I saw slightly earlier than the rest of the world, that I guess the sort of the building of this wave of this really strange thing. And my first reaction was similar to what many financial journalists were like, holy crap, this is amazing, this is unprecedented. And then it took me a few days to have a more nuanced take of it, which is really expressed in the book. I think that the good thing about the book is it tells the story, but it doesn't just tell the story. It tells you why it's important. It tells you why it's really a story that's repeated itself again and again and again on Wall Street, and hopefully holds some lessons in addition to being entertaining because it's a crazy story.
Yeah, definitely. Well, I guess sort of events like this is probably why you transition maybe from normal finance to actually, financial journalism.
Yeah, I mean it's a bit of a pay cut, I'll have to tell you, but I mean I remember talking to my wife years ago, and I was just really bored with all the sort of just meetings. There's just a lot of marketing, when you're a highly rated analyst in the city, and so it's nice, but it's basically how many people can you call, how many people can you meet, how much can you ingratiate yourself. And I was like, I actually am really interested in all this finance stuff. It would be nice to a have time to think about it and maybe even write about it. I always like to write, but also to have the excuse to call up smart people and talk about it. And if you read the book, you'll see that it's not just my musings. It's a lot of smart people from fields that I don't usually consult. I mean, I spoke with social psychologists, I spoke with gambling experts, I spoke with all kinds of people who really help put the picture together, famous short sellers and what have you, and young people making a film about why people did this, why people are in the meme stock world to begin with, and young people who participated in it and didn't do so well.
Yeah, definitely. Well, I guess that's why I have the podcast, and probably similar to you, it's just talking to different people from different finance is one of those things that's just so broad, and you can never stop learning. So, you need to invest a lot of time to talk to different experts to learn more. So we'll sort of go on to the book, and so while I'm sure most people listening have heard about WallStreetBets and what they did, it was a massive news story. Can you maybe talk about the group, maybe how they started, and what you think really attracted so many like-minded people to this group?
Well, Reddit was a great place for it to be born, and for those of you not familiar with Reddit, there are communities for everything. There are probably 100,000 active communities, and many more that are, if you include the dormant ones. So there's a group and a subgroup for everything. You'll have a group, and then it'll splinter into smaller ones. And so this was just one of those 100,000 groups. It was not that big, going back in 2013, 2014, 2015 was getting started. And the name tells you a lot about it, because the founder, Jamie Rogozinski, who I interviewed for the book, very interesting guy, no longer affiliated with the group as of 2020, but he was looking for a place where people could literally discuss bets. Bets are not investments. Bets are a little bit different than investment. Bets are a little wild. Bets are sort of trying to take advantage of some dislocation. It was the goal was to make money just like an investor does, but it was to do it in a more on the edge way. And that was the ethos from the beginning. And it, being the membership basically, from everything I can tell from what Reddit has told me and what surveys have told me and just observations. Obviously, everyone has a pseudonym on Reddit. Uh, it's males between the ages of, even like from their mid-teens, people too young technically to have a brokerage account, but mostly late teens to their early 30s. Not overwhelmingly male, kind of overwhelmingly kind of online brash group of people who not like to show off. They like to show off about the smart things they've done and the dumb things they've done too. And that's a bit unique, where there's a sort of tradition of loss porn on the site, where people show off, like some dumb stunts that they did and tried, and then wound up, losing 80% of their money, stuff like that, which is refreshing, I guess. But it was a natural place for this to begin, but no one would have guessed that this, like an online movement, would begin there. And I think a lot of people who are there today or were there at the beginning will tell you that that was never the goal. It was never the goal to sort of to blow up hedge funds and to kind of overthrow the financial order. The goal was to have some fun, trade some jokes, put up some memes, and make money and hack the financial system in some way. And there were a lot of hacks there that were shown. But then over the course of several weeks, as people saw that they were causing real distress to established people in the financial world, that caused millions more to join. And a lot of those people who joined late, I guess, like people who join a religious movement late, had were more fervent than the original people. And their idea was, and that's what makes this such a crazy story, was to do damage, not just make money, but to do damage. And that was their goal number one for many of them: cause mayhem, do damage, stick it to the man. And they really didn't. I think that most people on that group, I think, still don't totally grasp that, or don't want to understand that they did not. They contributed. If you look at Wall Street or the financial world writ large, they liked it. It was a good time for them. The whole build up to it, the the period itself, and the aftermath, except for a few extremely unlucky funds that lost a lot of money, uh, did great.
Yeah, because if you look at it, the majority of these of Wall Street makes money off people trading, off volatility, and this basically was just an absolutely massive catalyst, I guess you could say, of volatility, that a lot of, like, Citadel, which was one of the main targets, but they actually made so much money through their market making and everything like that.
Yeah, and more broadly, the Robinhood went from Robinhood is, for those of you in the UK are not familiar with it, or not familiar with the story. There's the Robin Hood, the legendary figure who stole from the rich and gave to the poor. But it's the name of the kind of the not a leading broker, I wouldn't say, but the leading broker of held by used by younger people newer to investing. About half of all investment accounts opened in the last 5 years in the U.S. have been opened with Robinhood. Those are small dollar amounts. The median account value is tiny compared to the larger players. But there are lots of them, and they let you do everything, and they let you do it very easily. They make it very colorful, very intuitive. They let, will lend you money. They'll let you buy options with very little oversight, derivatives and things like that. And so it became the sort of kind of heroic for a brief time, and then became a villain uh, abruptly, because they almost blew themselves up as a result of allowing this to happen. And it's still the target of, at the center of all kinds of conspiracy theories, because they were seen short circuiting this revolution that could have, blown up Wall Street. In theory, it wouldn't have, but that's how people see it. And Robinhood became the enemy. Robinhood made so much money off of this thing on both sides of it. They made money not just from all the commissions that, well, not commissions because they don't charge commissions, but indirectly, because they sell the orders that people make to companies like Citadel and Virtu. That's how trading gets paid for these days in the United States, especially for Robinhood, because they don't have all these other services they sell you. These are people, and they're not opening complicated retirement accounts and things like that. They're just trading for speculation. And so that's how they have to make their money. They also make money, by the way, lending out your shares, which is a point of outrage and something people. It's just so ironic. Their clients were the ones buying these shares in the meme stocks and trying to blow up hedge funds who were trying to find shares to borrow, and they were making very good money lending out those shares for high fees to the hedge funds who were on the other side of the trade. So they were like an arms dealer, and loving it until they almost went out of business because it was just too good.
Yes, as you said, they were, and when these retail investors were pushing up the price, there's less shares available. They were making more money off loaning because there's that supply demand sort of thing. So they were
Yeah,
literally, as you said, they were making more and more money off off lending out these shares.
yeah, that's right. Yeah,
Yeah, exactly. And sort of one thing you mentioned there was like the gambling aspect of it, and the fact that the group actually started focusing on bets. And I think one thing I've seen you sort of write on I think it was an article online, was a Kelly criterion, which really
yes,
says that the I think it says the more speculative the bet, the less money you should put on it. Whereas a lot of these retail investors were doing the exact opposite. They're putting all their money on it.
yeah.
Sometimes it's small, sometimes it was 10, 20, $30,000, which was a lot for them. So do you think that was it just because they had no education, or do they treat it like gambling? Why were they doing this, putting so much money on it?
A variety of reasons. I'll explain for a second, not to make anyone's eyes glaze over. The Kelly criterion was developed by a brilliant scientist at Bell Laboratories in the US who also liked to gamble. And is basically a formula for not going broke. For basically, if you have a good feeling about something, it takes your confidence in that outcome. Let's say you can beat the house on something. Even if you can beat the house, you don't have a 100% chance of beating the house. You never do. And so it basically tells you what the right amount is to bet to maximize your expected outcome and not go broke. And if you are really, really, really sure, like let's say buying Bitcoin or Dogecoin or whatever, you're really, really, really sure. People who buy that tend to be extremely self-confident. They don't have, unfortunately, the perspective of all the investments, all the thousands of investments over history that have gone to zero. And but whatever, let's say that they're right, and let's assume that they're right, and that these things are really surefire money makers. They take too much risk because if I know that something is going to go up a tremendous amount to be, like some of the projections that you see for these meme stocks, for example, where they have extremely high target prices, and they're sort of pulling them out of thin air. They're not based on any fundamentals, but that's what they think, or that's what they say they think. And if what they say they think is what they really think, then they should not make a very big bet on it. That's counterintuitive, right? If I could tell you that there's a surefire money making opportunity, you might invest every cent you have in it. But that's not what you do when you're very confident but not 100% confident in something, because the amount of money you'll make from that small bet will be very meaningful to you. And any additional dollar that you commit to it is just a needless risk, because it's already a transformational amount of wealth. So the why do people make such big bets? I think they do it. First of all, one reason is simple, is that these people don't have that much money. And if you're 23 years old and you bet $1,000 that you saved up from tips at a restaurant, or that you got from a federal government stimulus check, or what have you, um, it's kind of like easy come, easy go. Some of it was found money too, because during the pandemic, and it was a perfect time for this to happen. The if you get a check from the government you weren't expecting, if you getting, all of a sudden you're living with mom and dad, because you're sort of locked down, and you're not, you used to spend all your money going out on Friday night, and now you don't have anything to spend it on. It's like it's not real money. That's like house money. Like imagine, like, you want a big hand in a casino or something, whether you're an experienced gambler or not, more likely not. All of a sudden you have this money, you're very likely to lose it, because over the long run you're going to lose it in a casino. But the kind of found money effect will cause you to be much more ready to gamble with it. And so that's one reason that people were very ready to speculate with this. And it's true that if you're young and you lose a large amount of money, large to you at that age, you don't have a family yet, you don't have, you can bounce back relatively easily and hopefully learn a lesson. But it's also true, unfortunately, and it's like I go into this in the book, it's not just okay. First of all, you're making rich people richer, which is the exact opposite of what you set out to do. You made rich people made a lot of money off of this. Executives too of the companies, some of whom are still treated as heroes, revered by this group. Uh, Separately, though, you might become quite disillusioned with this whole world of investing. Your show is fantastic because it, to the extent that people your age are listening to it, it's so important to start investing in something. The stock market is the easiest one out there. That you can compound wealth over decades, especially in the United States, but other countries too. The government is not going to be there to help you very much when you're old and you can't work anymore, when you need to pay for important things in life. So, you know, getting on that ladder and starting to invest is important. Now, if these people, let's say they lose $1,000, well, it was just $1,000, big deal. But if that $1,000 loss causes them to distrust the stock market and investing and the whole financial world, and they keep their money in the bank or don't save at all, then that will cost them hundreds of thousands of dollars over their lifetime at the time when they're most vulnerable financially, not when they're young and can bounce back, but when they're old and can't bounce back. So it sounds abstract, but it's kind of some not insignificant percentage of the people who are swept up in this meme stocks craze will that will happen to them. Um, the bright side is a lot of people got into investing because of it. And you can open up a Robinhood account and be a free rider. You can open up a Robinhood or any brokerage account there in the UK or Australia or anywhere anyone's listening to this, where commissions are very low today, much lower than they have been in history. You can open it up with just a little bit of money. It was impossible decades ago to do that, and you can start compounding your money. And the broker's not going to make any money off you if you are very kind of inactive and careful with your money and don't waste money and aren't checking it all the time. You can make a lot of money, and the account is kind of like a money loser for the broker, but it's a money maker for you because the broker is still in business because of all the people who are reckless. It's just like credit cards, right? My oldest boy, who I mentioned in the book, he was in university at the time the events took place. He's now out of university. He just today he got he's here at home because of this latest COVID outbreak and working from home, and he got a credit card application mailed to him, solicitation. So, oh, I don't know. I said, listen, I mean, he's like, oh, 20% interest. Like, yeah, but you're not going to pay 20% interest. You just pay off your balance. You're being subsidized. You get all these rewards. They're going to give you this and that because of those people who pay 20% interest. You're a free rider on the innumeracy of some of their customers. So you can. There's nothing bad about opening one of these newfangled brokerage accounts, or whatever. Just be the person who is wise to the game rather than the person who's subsidizing others who are wise to the game.
Yeah, and I found that super interesting when you're mentioning, as you said there, the compounding, like, because if you miss the first, say, 10 years, that could have a massive impact. I think it's like, I'm not sure the exact numbers, but, it could, as you said, it could be hundreds of thousands of dollars that these people are missing out on in their future retirement, which is absolutely crazy. But, we'll go back to the story. And, I think all the points you mentioned were really interesting there. And one of the main heroes, I guess, of the book and who's mentioned quite a lot was Keith Gill,
Mm-hmm.
who was, really the first person to share his investment theory about GameStop. And he really doesn't seem to fit the story. It seems like he's
Yeah.
almost like the complete opposite to a lot of the other people who are
Yeah.
actually making these trades. So, do you think there was anything in particular that sort of attracted support from the retail traders? Was it because he was different, or do you think he was just in the right place at the right time and got lucky?
No, he was in the right place at the right time, but he also it's so interesting, right? Because he is a chartered financial analyst, which is a series of exams. It's quite a difficult series of exams. Requires about 1,000 or more hours of study. He worked for a financial institution. He wasn't wealthy. I think he was in his first high earning job. He worked in he was anonymous, so he people did not know who he was. And for 90% of the timeline, I follow him along with him. He was just this fringe figure that people sort of, barely tuned into on social media. Not that he didn't try. He didn't really care. He was just out there basically using social media to sort of get people to test his views. And if you look at the timeline on Twitter, people were making fun of him. He bought this, he made a big bet on this stock because he was a value investor. Very risky bet, I have to say, because it was an all or nothing bet. He used options, but he was very confident in himself. But people thought that he was a buffoon. People thought it was ridiculous. They were telling him to sell. And all along, he's explaining all these tenets, making people's eyes close over value investing. No, that's not how you do, and that's the wrong, attitude. He wrote incomplete sentences. He used memes too, because he's a 34, 33, 34 years old at the time the events take place. So he's still in that group, long hair and drinking beer on his YouTube channel where he was roaring kitty. But he was ignored until people caught on to the potential for a short squeeze. And all of a sudden, they saw all these messages that this guy had written about the fundamental argument of this company. And he, by in turn, realized that in addition to the reasons that he thought GameStop could actually be a pretty good investment, he might make 5 times his money or something. He actually made 5,000 times his money because this short squeeze happened, and it was like this feedback loop because he became an instrument in it, because people would check every day. He was the center of attention for millions of people who would check every day. All he did was put a screenshot of his account. The less he wrote, the more effect he had. And it's a concept called social proof. If you see somebody who's successful doing something, even if the reason they're successful is, it doesn't matter why they're successful, I'm going to pay attention, I'm going to copy them. And he was not only very successful, but also very confident. That's the other thing. If you're very confident on social media, and you couldn't have been more confident than him. He was immovable, and people just couldn't believe it because he had made millions of dollars and he kept on pushing his luck in this bet. And because he was pushing his luck and because he had made so much money, he drew more people into it. And I don't think it was his intent at all, but that's what it became at the end. I think I towards the end he was actually quite um, you know disturbed by it, because he made clear that he never told anyone to buy it. He faced some legal repercussions if he was, because he was technically a financial advisor, even though he didn't have clients. But yeah, but he became the hero to millions of mostly young people in the United States and elsewhere. And then he disappeared, and then he was summoned to Congress, and people got to see his face for the first time 3 weeks after the kind of the events took place. And he was perfect. He was like this sort of, I think people don't really turn into congressional hearings usually here in the U.S. They're very boring, lots of grandstanding, but everybody wanted to see him, and everybody wanted to see the other guy who lost $6 billion because of him. Gabe
Yeah,
Plotkin, who I follow a bit in the story.
yeah, definitely. And you mentioned there was the three, and the two billionaires and him who were there
Yeah,
to talk to Congress.
yeah,
But yeah, and there's the classic quote, I like the stock, which was, I think, is everyone's probably seen it. So we've talked about Keith, we talked about GameStop, and GameStop was one of the companies. There was actually quite a few more highly shorted companies that there was a short squeeze on, that WallStreetBet tried to organize it. So maybe can you talk about it, because it wasn't really maybe it wasn't over a few days. It was almost over months and months of these companies,
yeah.
that this group of people try to increase, do a short squeeze. So you can talk more maybe about a few other examples of it and how that happened.
Yeah, sure. Well, so in the autumn of 2020 was when this really began to gain steam. And it's so interesting because so many things had to fall into place for this to happen at exactly the right time, and they did. And so GameStop was the sort of the match that lit the fuse. But then there were, as you say, there were many other companies there, and all the companies that this happened to were loser companies, basically. I mean, by loser companies, I mean they weren't developing an electric vehicle, they weren't going to revolutionize anything. They were all has-beens, including GameStop. GameStop is and I know it exists in Australia and the UK, although under a different name, but it's where you go buy and sell video games, you buy a console. That's not a great business anymore. Everything's become digitized. It's like Blockbuster Video 3 years before it went bankrupt. It existed, but it was kind of a punchline. I have three sons who all like video games, so I can tell you that's three of their best one once upon a time best customers are not going there very often anymore, and that's kind of par for the course. GameStop, BlackBerry, which used to dominate the smartphone world, and now is whatever. Now is also a punchline. I mean, it was like, Apple was nothing and they were everything, and now they're nothing and Apple is everything, and Samsung and whatever. There are companies that made wired headphones. There are companies that you know that were being put out of business by Amazon, that sold towels and bedding and stuff in physical stores. And what they all had in common, and AMC, which was a movie chain that was dying because of the pandemic and also dying because of streaming, had been kind of losing money before that. What they all had in common was that these fund managers felt very confident betting against them, because they had been burned very badly especially in 2020. It was probably the worst year rather in history for selling a stock short. Selling a stock short means betting that it will decline, which sounds like a terrible thing, but it's just a normal part of the functioning of financial markets. And the way that you do it typically is that you sell stock that you don't own, which is not illegal because you borrow it from somebody. You go to a broker and say, I want to borrow the stock. I say, okay, you borrowed it. I'm going to charge you this little bit of money to borrow it. Like, okay, now that I borrowed it, I'm going to sell the stock to somebody in the market. So when you buy stock, the share that you're buying might be sold by a short seller. You'll never know. Doesn't matter. It has no bearing on what you're doing, because it's a real share that you own. But they have to. The way they make money is they wait for the share price to decline, and then when it goes low enough, then they'll buy it back at a lower price, and then return the borrowed share, and they made the difference. The most that you can make as a short seller is 100% return, because the lowest stock can go is zero, can't go below zero. But there's no upper limit to where a stock can go. And so, in the 19th century and early 20th centuries, there was like a wild games played with between short sellers and their adversaries, where they would do all kinds of things that are illegal today. Where, like, let's say, I don't know, that Cornelius Vanderbilt is, big tycoon, was short some railroad stock, and then three other rich guys would get together and say, hey, let's screw him over and he'll have to pay any price. We'll buy up all the stock available, and then say, hey, you can't cover this short, pay us 10 times as much as you paid, or we'll bankrupt you. And you can't do that anymore. And then Cornelius Vanderbilt would turn around and illegally issue a million new shares of the stock and then bankrupt the short sale. I mean, there are all kinds of games played that you also can't do today. But what had never been tested before is, like, what if a bunch of people on some message board on Reddit got together out in the open, you know, and like a few 100,000 people, and all did it at the same time? That's probably not illegal. And even if it's illegal, there's nothing you can do about it. Nothing you can do to stop it. And so they found that GameStop was becoming the center of attention. Kind of a dot-com hero named Ryan Cohen, who was the founder of Chewy, which is an online pet goods retailer here in the U.S., had bought into it and kept buying more of it, and wanted to change the board and wanted to do all these things. And every time he sort of showed up with more of the stock, or did some other corporate action, the shares would go up more. And their rise was exacerbated by the fact that the shares were so heavily shorted that more than 100% of the shares available to purchase were shorted, which means that you've left yourself no exit in theory if you're a short seller. And that was very reckless of them. And there was a lot of hubris on the part of the fund managers, the hedge fund managers who were shorting the stock, because this wasn't central to their bet. They were selling lots of stocks short. If one didn't work out, let's say somebody showed up the next day and bought GameStop for twice what it was worth. Well, that'd be a really bad day for them, but they'd be okay, right? What's the most you're going to pay for GameStop? It's GameStop. It's a joke, right? But what they never imagined was that you would have this active movement to bankrupt them going on, and the people would buy faster than they could buy. And they found kind of these weapons of mass destruction out there in the financial world that could give them much more firepower, which were stock options, where they would buy call options. And they specifically would buy call options that weren't likely to make them money, but that would force the people who had sold them call options to buy lots and lots of the stock to protect themselves. Because call options are basically you're buying a contract that says, at some future date, at some future price, I can purchase this many shares of the stock. But they'd buy it like with options that had very low probability of ever paying off. But then if they do, then you make a tremendous amount of money because you're paying pennies for them. And if you take thousands of your pennies and buy them, then the turnover in these was huge. And they some people on the message boards were openly discussing how to do it and what to do. So clearly there are some sophisticated people who who we've never um, discovered the identity of. Although I suspect they're people who have some financial experience, might even work in the financial markets, who were planting the seeds of these ideas and getting attention and saying, hey, this is going to be the biggest short squeeze of all time, and this is how to do it. And people were taking notes.
Yeah, and I think that was one thing that you mentioned after GameStop. Then a lot of people, a lot of new members went, and they almost had to shut down the actual the website taking new members because there was that fear of that happening, people going in there and taking advantage of it. And there was a silver squeeze, which was another thing
Yeah,
that happened as well. Yeah.
yeah. It's been attempted time and time again with less effect, because you surprise people the first time and you did it with a little bit of money. Now there are tens of billions of dollars, even as we speak, tens of billions of dollars being pumped into these options that are expiring mostly worthless. So it's these people's savings going up in smoke because they also own the stock and they're trying to affect an outcome. But it's harder to, everybody knows about it now. It's harder, the there's the price of an option when something is volatile, the price of an option for it gets a lot higher. You have to pay a lot more for it. You can't make the magic happen again. I mean, there have been limited victories, but they're just pumping money into the pockets of these options dealers who love it. It's kind of sad to see.
Yeah, definitely. They're almost trying to, as you said, they're trying to recreate it, but it's not possible. And one platform that you mentioned before was Robinhood, which is obviously massive in the US, and it's really the main brokerage that had a lot of the volume going through it. And they were obviously on the bad. They became the enemy because they stopped the potential buying of
Right.
these products, and that people were saying that was because Citadel forced them to, because they were trying to, they had massive losses. But then you mentioned actually in the book how it was very different. It was more based on collateral, and Robinhood almost blew up just because it was so successful at getting people to trade these very, basic
Yeah,
bets, these very, trading
it blew
ideas.
itself up, or almost blew itself up.
Yeah,
Yeah, because the thing is like that, all these stock transactions, they don't happen instantaneously. They take a couple of days. And so I bought these stocks and sold these stocks. You've sold these stocks and bought these stocks. And there's millions of people. They're obviously it's electronic. It's not pieces of paper any longer, but it's still a tremendous amount to settle. And so the payment happens a little bit later. And so usually that's fine. But they realized after the financial crisis here in the United States that if anything happened to the government clearinghouse that makes sure that everybody gets paid, that there would be a big problem. And sometimes brokers do go bankrupt. Sometimes brokers can't cover their clients' trades, and so you need to leave some collateral. And it's kind of mutually insured. So all the brokers, depending on the size of their business and the amount of risk their clients are taking, have to leave some hundreds of millions of dollars or maybe billions of dollars just on deposit. They get the interest on it, but they leave it on deposit just as sort of, safe money. Because if one of them goes bust, then everyone else is on the hook. And Robinhood, because its clients weren't just taking a lot of risks, they're all taking the same risks in the same stocks, and they're using borrowed money, and they're using derivatives, and they were all making the bet in the same direction. If that reversed, many of them really were just like opening accounts and then being lent the money in their account before the money had even cleared, had even gone through the banking system. Robinhood was just saying, yeah, sure, you can, here's the money, you're good for it, you can trade, or letting them use borrowed money as something called margin lending. And so the people sat down at this clearinghouse and they said, okay, well, let's quantify the risk. Oh, well, instead of the 700 million that you have deposited with us, we're going to need about $3 billion more, and we'll need it in 3 hours, please. And there's no way that they could. $3 billion is more than they had ever raised in their entire history as a company. There was absolutely, absolutely no way to come up with $3 billion, even the United States, even in the middle of this, even though their business was going very well. So they we're basically going to be out of business in 3 hours. And they went back and they said, okay, if we don't, because they knew that when the bell opened that all these other trades were going to be placed on the same exact stocks. And they said, if we restrict purchases of stocks and only allow sales, so allow the trades to be unwound but not increased in the stocks that you're so concerned about, and it was a list of 13 companies, then what do we owe you? Then what's our risk? And they went back and they basically cut them a break, and they said, okay, it's only 700 and something $1 million, which miraculously they came up with in, before they had to start trading. They raised $1 billion that day. They drew down their bank credit lines. Their investors gave them over $1 billion that day, which is amazing. And they gave them, and more as the days wore on. And so they stayed in business, but they became the enemy. And basically by not allowing people to buy those stocks, they're like, oh, it's like heads, you win, tails we lose. That's basically. And if you don't know anything about how the financial system works, like every talk show host, every politician on the left, on the right, it was something people all agreed on, that they had screwed over these young people. And there must be something really suspicious, because all people knew is that these hedge funds had lost all this money. Now this kind of saved these hedge funds money. And that's not actually what happened. First of all, the hedge funds that lost a lot of money already had lost that money. They already had tucked tail and run away and were licking their wounds. They'd already lost the money. They weren't upping their bets. They lost a crap load of money, right? And then new people came in who said, this is crazy. This can't last. This will be over in a few days. Some of them were losing money too. They kind of got bailed out by this, but it was totally new players who came in. And I'm not going to name names, but I can tell you, well, I do name a few names in the book, but there were a lot of rich guys on Wall Street. Guys I know, people who I name, people who I don't name, people who I've spoken with, who took the opposite side of the bet, and they made a lot of money, and they probably would have made a lot of money anyway, but they might have been bled dry before they could make that money, had Robinhood not taken the step. Having said that, Robinhood didn't do it on their behalf. Robinhood did it because it didn't have $3 billion in 3 hours. That's why it had to do it. And the hedge funds that were on everyone's lips, Melvin Capital, Andrew Left, the short seller, like they were all licking their wounds. They were out of the trade. They were out of it. You can say that a million times, and people are going to say you're lying, and this person lied, and it's one of these theories that you can argue. I'm not going to argue with people. I know the facts, and that's not why they stopped trading. And it's just a conspiracy theory that won't die, which is unfortunate, because like it's a conspiracy theory about being screwed over. And what and my whole book is about how the people those people got screwed over. I really want young people who are at least somewhat involved or had friends who were involved with it to read the book, so they understand exactly who profited from them. I spell it out, and who always profits really from retail investors. It's Wall Street. They love this. They love it when the dice are hot. That's a great profitable time to be on Wall Street writ large, with a couple of exceptions, obviously.
Yeah, definitely. And that's sort of what you recommended before, where, that's why while it was a massive event, it wasn't a revolution, because, these people just became richer, and most of Wall Street became richer and richer, with only a few actually really feeling the pinch.
Yeah, yeah, and I mean, I can understand why people resent Wall Street. I mean, here in the United States, if let's say you're 30 years old, or in your late 20s, early 30s, your formative financial experience was, um, first of all, probably seeing your parents struggle with their mortgage or possibly lose their home, seeing people lose their jobs during the financial crisis, and see people in the financial world come out of it, not only kind of unscathed and mostly not prosecuted for anything, but to come out, richer. Like the solution to the problem was to throw lots of money at Wall Street and make money very cheap, and it helped them. It exacerbated wealth inequality, by allowing rich people to become richer. It didn't really help um, people on the bottom rungs or people just getting started. And it's much less common today than it was a couple of decades ago for a 30-year-old to own a home here in the U.S. It's expensive, even though mortgage rates are low. It's just there are lots of hurdles. They have student loans, entry level jobs pay pretty well, but not that well. And there are lots of costs. There's lots of insecurity, and so I can see why Wall Street is cast as the bad guy. I'm going to kind of just remain on the sidelines about that. I'm a journalist. I'm not a polemicist, but it's I completely understand the sentiment. But you don't get at somebody by giving them your money. That's not how to get someone, and that's indirectly that's what they're doing. And people would say, "Oh no, I made a lot of money on GameStop. I didn't give them my money." Like, okay, yeah, but I mean, but as a group, you know, this kind of this movement has enriched people on Wall Street, including by the way, the Ken Griffin, who's a central character in the book, who is the largest shareholder and the biggest firm that executes your trade if you're using one of these brokers. They're the biggest player there, and it's a really good time for them. This whole episode and the many months leading up to it, especially, were a great time for them. They were very profitable.
Yeah, and he still seems at war with them. I think he bought the Constitution recently. He's
That's right.
it's some
Yeah,
some crypto people, so I guess he's still trying to show it to them, which is
yeah.
quite.
My jaw dropped when I saw that. That was a real kind of sticking it in their eye. But yeah, I mean, uh, it's funny and sad at the same time. I mean, but it's the thing is, like, here's my message to you. If you and this is a twofer, if you're a young person getting started and you don't like Wall Street, but you do like financial security and having money, the answer is the same. The answer is to you do need to engage with Wall Street a little bit in your life, or you should, but do it on your terms. Do it in the sort of the most passive and cheap way possible. Um, if you basically, sort of very infrequently touch your investments, if you buy things, don't trade a lot, don't transact a lot, don't pay anything or pay nothing basically to Wall Street. And you can get away today with paying nothing. A long time ago, you couldn't do that. They screwed you over no matter what, especially if you were a small fish. Today, if you're a small fish, you can get away with paying nothing. You're below their radar. You're taking advantage of these expensive services they've built, and they're not really earning a dime off of you, or hardly earning a dime off of you. And you in the long run will get pretty wealthy if you just steadily plow your savings into conservative investments, stocks or low cost index funds. That sounds really boring. That's not as exciting, obviously, as being a speculator. And I understand that too. But you know what? If you really can't stop yourself, and there's a real gambling instinct that's kind of been brought alive in young people, that's migrated from actual gambling to gambling on financial things, then have like a little bit of your money on the side and use it for that, not the bulk of your money. If you want to show that you're the next Warren Buffett, or you're the next whoever, you're the next Keith Gill, go for it, but do it with a little bit of your money. So make it an intellectual exercise. Don't make it a financial exercise.
Yeah, and I think that's a great piece of advice, and that's something that you mentioned at the end of the book of how how you can go out and actually beat Wall Street. So, Spencer, thank you so much for joining the podcast today. Just on to my last question. You talked about how the revolution didn't happen, but do you believe hedge funds have learned from the situation? And are they prepared for similar situations in the future? But I guess there's also a risk that if there's no one shorting the market, there's almost going to be this, they're too scared to short the market. There's going to be a disassociation between the actual value of a company, but the price of shares. So do you think that's another risk as well? Sorry, I put a few questions in there.
Yeah, two great questions. Yeah, so I can tell you that, I mean, I speak with people in the hedge fund world, and they're much more aware. So there are many services that they pay for. There were the smart engineers who basically that week, came to them and said, hey, we have this service where we use natural language processing and we go through this and that and all these forums. And basically they can read, they don't only read what's written there, but they read sentiment, and they can tell what's a bot and what's not. So they can read it more quickly and more intuitively than you can, and convey that to them and even trade on it. So they're looking for all kinds of social signals from social media, and they're prepared. And the second part of your question, which is related to the first, of course, is are they have they kind of drawn in their horns? And yes, and that's unfortunate because short sellers, they're routinely portrayed as these sort of bottom feeders and scum and whatever. And short sellers, that's not true at all. You need them in the market. Of course, they're like anybody else. You're trying to make money in all likelihood if you have a brokerage account by buying a stock and having it go up. They're making the opposite bet. That's a pretty tough bet to make because you're really betting against history. The history is in the stock market is won by the optimists, but they're picking their spots. They have to be very careful because their losses theoretically are unlimited. But they are out there trying to. Obviously, there are people who are unscrupulous and any corner, any type of business that's financial. But for most part, they're there trying to pick and identify losers, and some of the more vocal ones are out there then yelling it from the rooftops, because it's not enough to say that Enron is a fraud. To decide for yourself and sit there and sell the stock short and wait while it's like a hot stock. You also call a friendly reporter and say, hey, by the way, Enron is conducting fraud, and then and you're rewarded for your research by being vilified and whatever. And eventually Enron is exposed as a fraud and is the largest bankruptcy in US history at the time. Those are the sort of career making moves that most trades are not as lucrative for short sellers. But you want someone out there who has a financial interest in pointing out that Enron is a fraud. The longer that Enron is able to suck up, they're all their employees were encouraged to invest all their savings in the company. They not only lost their jobs in the middle of a recession, they lost all their savings. I mean, lots of people, thousands and thousands and thousands of people were hurt by WorldCom and Enron and Valiant and all these things that were brought to light by short sellers. So their absence first of all, it makes markets less efficient because they provide a lot of liquidity to the market, which makes markets better for you. But they also are out there looking out for you. If they're not there, or if they're not as active, or if it's very difficult to be a short seller, which is ironically one of the things that regulatorily might come out of this whole episode. They're kind of cast as the villains here, and they're not at all. They were the losers. So then they're being kicked on while they're on the ground. Is that if you make it harder to sell stocks short, then the price of stocks is not going to be correct. And when the price is not correct, you as a less experienced investor go in there and you see that, uh, uh, and or you see people attacking the short sellers and saying, hey, they have this ulterior motive, they're sleazy, they did this, they did that. I'll tell you, there's a close friend of the family, who turned into, like, this woman didn't spend any money on anything, just charitably basically, and she wanted to retire. She was retired, she had just retired, and this is a friend of my mother's. And this is right before the financial crisis, and there was a company. I'm not going to say, give too many details away, but basically it was not, it was being targeted by short sellers. It was a firm in the mortgage industry, that had never lost money, that had never anything, and all of a sudden it was being targeted by short sellers. And I just came out in conversation that she had put a substantial portion of her savings into this company. I mean, urging her to sell. And she said, no, no, it's the short sellers. Like, listen, I mean, I was a managing director at the research department of investment bank. I write for the Wall Street Journal. You know, I think I was the Financial Times at the time, whatever. But I mean, I'm telling you, and she just didn't want to hear it. People are just put their blinders on. Well, her retirement was wiped out. She had to, quite an advanced age, go back and take a not very, you know, nice job, just to pay the bills. I mean, so if short sellers had been a little bit more effective or a little bit faster to the game, it would have saved her a lot of money. I mean, and so yeah, obviously they're talking their book too, just like anybody does who goes on financial television and talks their book. But they're a really important part of the financial ecosystem, especially when it comes to people who are who are less experienced and easily duped.
Yeah, I agree, and I just hope that the lack of short sellers doesn't lead to overinflation and a bubble. But who knows? I think people have been calling bubble for the last 5, 6, 7 years, and we haven't seen that yet. So
Yeah, well, they'll get them one of these days. But I mean, you can't. I wouldn't recommend, by the way, that anyone who's a retail investor engage in short selling, because it's a very, very dangerous game. I'm just saying not to ignore or vilify short sellers, or to sort of be more dismissive of someone's advice because they happen to be betting on the short side than the long side. They're the ones with the potentially unlimited loss, not you.
yeah, definitely. And as you said, it's
Yeah.
just you need that balance of things happening. So, Spencer, thank you so much for your time. I really appreciate it. So if anyone wanted to buy the book or pre-order it, I know I mentioned Amazon before. Is there any other places, and maybe where else they can sort of see
Wherever
content you release?
wherever fine books are sold, depending on where you're listening to it, it's available in the United States. Obviously, the publication date in the U.S. actually has been moved until February 1st, and I'll just a heads up, it's possibly will be moved a few days in the UK because of supply chain problems with the
Okay.
printer. So it might not be January 27th, but you can pre-order it today as we speak, and perhaps by the time you're listening to this, it'll be for sale. But Waterstones or Barnes and Noble or wherever you buy your books, it should be available at all those places. It's available in traditional and simplified Chinese, so in mainland China and in Taiwan. Not sure about the date there. I'm really looking forward to getting that those books on my shelf, though, because it'll be cool to have something with my name on it in Chinese, and possibly some other languages. So this meme stock thing was a subject of fascination, even though it happened in the United States, um, all over the world. I have someone in Russia urging me to publish the book there. Said, "Oh, meme stocks are huge here. Definitely publish your book here." So I hope that happens too.
Yeah, hopefully, I hope you have a whole row of different languages
Yeah.
for the book. That'd be great. So, Spencer, thanks again for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.